Hi everyone, welcome back to our channel. Today we're diving into some serious global economic news that could impact your wallet. The International Monetary Fund, or IMF, has issued a warning about rising global economic volatility due to increasing trade tensions and tariffs. Let's break it down. The IMF's April 2025 World Economic Outlook has projected a slowdown in global growth to just 2.8% this year. That's a significant drop from their January forecast of 3.6%. The US has enacted sweeping tariff hikes, which have led to retaliation from trading partners. These measures are weakening demand, fueling inflation, and threatening long-term productivity. The IMF is urging policymakers to stabilize trade policies, ease tensions, and pursue fiscal reforms to prevent further economic fragmentation and inequality. Now, let's talk about China. In response to US tariffs, China has halted all exports of rare earth minerals and magnets. This is a big deal because these materials are critical for high-tech and military industries in the US, Japan, and Germany. These restrictions, effective since April 4th, require export licenses that are currently unavailable. Plus, Beijing has suspended new Boeing jet deliveries, impacting around 10 Boeing 737 MAX aircraft. Boeing shares have taken a hit, but there's a silver lining. Reports suggest Air India may step in to purchase those jets. Despite these trade strains, China's auto industry is thriving with a 16% surge in Q1 exports, driven by strong electric vehicle growth. Over 1.54 million units were shipped, showcasing China's expanding footprint in the global automotive market. Switching gears, let's talk about the US Securities and Exchange Commission. Paul Atkins, a known cryptocurrency proponent, has been sworn in as the 34th chairman. This leadership change could lead to more industry-friendly digital asset regulations. Atkins, nominated by President Trump, is expected to prioritize creating a comprehensive crypto regulatory framework. The SEC has also established a new crypto task force to gather public input and clarify the legal status of various cryptocurrencies. Exciting times for the crypto world. Now let's take a look at the stock market. US stock futures surged after President Trump stated he has no intention of removing Federal Reserve Chairman Jerome Powell. This reassured investors after weeks of market uncertainty. Trump's comments marked a shift from his previous harsh criticisms of Powell, signaling a more stable outlook for investors. Finally, Goldman Sachs has issued a warning. They say US retail investors could trigger significant sell-offs of Chinese companies' American Depository Receipts, or ADRs, if the Trump administration moves to sever financial ties with China. With US individual investors holding about $370 billion in these ADRs, companies like Alibaba could face greater exposure. A financial decoupling between the US and China could lead to a staggering $2.5 trillion sell-off across US and Chinese equities and bonds. This highlights the growing investor anxiety and potential market turmoil from escalating geopolitical rivalry. Let's take a look at the economic indicators for this week. The US leading index for March came in at negative 0.7%, sharper than the forecasted negative 0.5%, and down from February's negative 0.2%. This bigger than expected decline signals weakening economic momentum, raising concerns about a potential slowdown ahead. Some good news from the manufacturing sector. The S&P Global Manufacturing PMI for April came in at 50.7, beating the forecast of 49 and the previous reading of 50.2. This better than expected performance suggests improving conditions, highlighting resilience despite broader economic uncertainties. However, the services sector showed some softness. The services PMI came in at 51.4, missing the forecast of 52.8 and falling from last month's 54.4. This cooling could be a sign of tightening financial conditions, impacting service-based businesses. Turning to housing, new home sales surprised to the upside, reaching 724,000 units, way above the forecast of 684,000 and last month's 674,000. This strong growth hints at robust housing demand, likely fueled by lower mortgage rates or pent up by demand. Oil markets are signaling caution. Instead of the expected drawdown of negative 0.7 million barrels, we saw a build of 0.244 million barrels. This unexpected inventory rise suggests weaker short-term demand and could put downward pressure on oil prices. Durable goods orders surged by 9.2% in March, smashing expectations of just 2.1%. This shows strong business investment activity, signaling confidence in the economic outlook, despite some mixed signals elsewhere. Labor markets remain stable. Initial jobless claims held steady at 222,000, matching forecasts and only slightly above last month's 216,000. This stability supports a positive employment outlook and ongoing consumer spending strength. And finally, a bit of slowdown in the housing resale market. Existing home sales dropped to 4.02 million units, below the forecast of 4.14 million and last month's 4.27 million. This cooling could be due to affordability issues or tight inventory. Next week, market attention will be focused on key economic indicators and earnings reports, including CB consumer confidence, non-farm payrolls, quarter-on-quarter GDP, crude oil inventories, and month-over-month average early earnings. Meanwhile, several major corporations are set to release their earnings reports, including Apple, Amazon.com, Microsoft, Meta Platforms, Pfizer, Caterpillar, Chevron, ExxonMobil, Eli Lilly and Company, and General Motors. So overall, the economic data paints a mixed picture, with strength in manufacturing and investment, but caution signals from housing, services, and leading indicators. As always, we'll keep watching how these trends unfold. But what do you think about these developments? How do you see the future of global trade and the economy? Let us know in the comments below. Don't forget to like, subscribe, and hit that notification bell for more updates. Thanks for watching, and we'll see you next time.